Hello everyone, my name is Radovan Vojtko, CEO and Head of Research at Quantpedia. So today I would like to discuss a reversal strategy. We have more than 120 reversal strategies in our database, so feel free to check out our screener if you would like to have inspiration how to build one strategy. And we will discuss how to build a reversal strategy in niche alternative ETFs. Why the reversal in those ETFs work. So the idea is built on the premise that in the time of the stress, for ETFs which are active, hard to value, because their portfolio is hard to value, there is a mismatch between the asset value, so the value of the ETF, and the price of the ETF itself. The price can get away from the estimate of the net asset value of the portfolio itself, and not because the fundamentals have changed, but because of the liquidity. So liquidity demand, hedging pressure, etc., etc. So that's the reason why there can be a mismatch between what is the value of the fund and what is the price of the fund. And those deviations, they create opportunities for the traders, for arbitrage-minded traders, can buy temporarily oversold ETFs, and we can short those ETFs that are, temporarily overextended. And we hope and we believe in mean reversion once there is a pricing efficiency which is restored and we can make some money.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
Same idea is working in high yield. If you are interested in the idea, you can check out our older article. It's probably 2 years old. We were checking this reversal effect in the high yield market, and it's present in the high yield market. The reason is, as I said, simple. So sometimes markets move very, very fast, and it's hard to value the portfolio of the ETF itself, and there is a gap or spread between the value of the ETF and the price. And in this case, we can buy those that are cheap one, and we can sell those that are expensive one, and we can have a nice profit after the price reverse back. What are the ETFs that we backtested? One of that is DBMEF, which is a DBI Managed Future Strategy ETF. Another is Wisdom 3 Managed Future Strategy Fund. Then we use the Merger Arbitrage ETF and Invesco S&P 500 by Variety ETF. So all of those are active funds. They are not passive only, so just buying the underlying portfolio. They trade the portfolio, and this makes them better target for reversal or arbitrage strategies, because as I said before, when there is a stress, you sometimes have a problem to give the value. What is the value of the fund? And in this case, the price can move from the underlying value. Okay, what are the basic strategies? Here we have how does the performance of the underlying ETFs look like, and the buy and hold of the underlying ETF, and then we have the short on a high strategy, which means that we are monitoring every day whether the fund is on its end day maximum. The end day can be 5, 10 or 20 days, and in case the fund hits the maximum, we can expect that it may be temporarily overextended. We will short that ETF for 1 day, and we will check out what is the performance. In charts, we still see that the gray line is the performance of the underlying fund, and all of the other lines are the performance of the strategies. And we go through all of the ETFs. So we have a DBMEF, here we have Merger Arbitrage M&A ETF, here we have PBP and VTMF. What we can see is that on average, equity curves of the strategies are smoother. Sometimes they outperform the underlying ETFs, sometimes they do not outperform underlying ETFs, but in all of the cases, the performance is smoother. So we have smaller drawdowns, better Sharpe ratio, better risk to return ratios in this case. So we can trade those underlying ETFs, and we can have alpha, or we can get alpha out of the underlying price movement. The same can be built on the other side. So we are buying on the end day minimum. Once again, when the fund hits the end day minimum, we can expect that it's temporarily oversold, and we can buy the fund for 1 day, and we can hold it just for 1 day. Once again, this is how does it look like for DBMEF, how does it look like for M&A. For M&A, it works extremely well. Here is the performance when you buy the M&A on 5-day low, and here is the M&A fund itself. So you can see that you are significantly outperforming underlying market. Here is on PBP, and here is for VTMF. In all of the cases, once again, the performance curves or equity curves of the strategies are significantly smoother than the underlying fund. What we can do is we can combine all of the assets. What is the logic in this case? We take the 4 ETFs, in this case is end day maximum, and we open a 1 day short position. So we are monitoring which ETFs reach the end day maximum. We buy those ETFs, and we allocate our positions equally among them. So if there are 3 ETFs at the same day, we buy 3 ETFs, divide our portfolio in 3 parts, and we short all 3 ETFs. If there is just one, we short just one ETF. What is the performance? So the benchmark performance is when we mix all of the ETFs ETFs together is 2.5% with a 11% volatility, 40% maximum drawdown, Sharpe ratio 0.28. In the case we will short all of the assets, we have 6 to 9% performance, 5 to 6, 7% volatility, maximum drawdown between 7 and 12%, Sharpe ratio over 1. So between 1.2 and 1.3, which are, very, very good numbers. Now we can turn around this strategy, so we can long on low. So once again, we can monitor all ETFs until some of them reach the end minimum, and we then allocate capital equally among all assets that meet this condition, and we hold this position for 1 day. Once again, we have the significantly better Sharpe ratio, significantly lower drawdown, lower volatility, better performance. And we can mix both legs together, short and long leg together. In the case the ETF reaches minimum, we will buy it. In the case it reaches the maximum, we will sell it. The best performing strategy is the one which is trading the 5-day minimum or maximum, and we have 20% performance, 10% drawdown, Sharpe ratio nearly 2, 10% volatility, 20% drawdown, gamma ratio nearly 1. Those are extremely interesting numbers. However, there is one catch, of course. We are trading the niche ETFs. ETFs are not very liquid. Trading execution can be sometimes complicated. We are using the end of the data, which may significantly bias the results, due to intraday volatility, etc., and it's without the transaction cost, so you need to calculate also the transaction cost. However, as a research, this idea looks very, very promising. So what you can do, if you have a time, you can broaden the scope of the ETFs that you would like to trade, so you can include more active ETFs. What is important is to include active ETFs. Include ETFs for which it's really complicated to say sometimes what is the value of the underlying portfolio, because it may change due to the market volatility, etc. It doesn't work very well for ordinary bond ETFs or ordinary index ETFs like SPI or something. This strategy works the best when the underlying ETFs are less liquid and active. And in this case, you can build your own portfolio, check out if they are in the minimum or maximum. If they are on the maximum, you can short them. If they are on the minimum, you can buy them, hold them for 1 day or just a few hours. What is the reason for the performance of the strategy? You are providing the liquidity. So you are a liquidity provider, and you are, of course, paid for that, and you are paid in the form of outperformance compared to the market. So I hope that you like this strategy. It's very interesting. Of course, it has some limitations. Please, you need to use the intraday data, take care of the proper trading execution, understand that there is low liquidity, etc. But if you are able to overcome all of these obstacles, you will have a very interesting strategy. I hope that you liked this video. In case it is so, please give us the like, subscribe to our channel. If you are interested in more strategies, visit our screener. We have more than 1,200 strategies in the screener. You will get, hundreds and hundreds of ideas for new trading strategies with the code, auto-sample equity curves, etc. So it really makes sense to subscribe to Quantpedia too. And I hope that you will join me in the next video. So thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.